Welcome to the Financial Advisors Want to Know podcast, sponsored by Dominion Enterprise Services. I'm Catherine Tindall, CPA and founder of Dominion. We're a tax and accounting firm focused exclusively on serving advisors for their own tax planning and filing needs as business owners. At Dominion, we work alongside advisory firm owners to bring proactive strategy, clarity, and confidence to their tax planning so they can focus on growing their firms. The focus of this show is to cover different areas that I've experienced as a tax planner, working with advisor clients in their lives, building their practices. So let's get started. Well, I cannot believe that this is already the 100th episode of this podcast. As I reflect back on all of the different wonderful guests that we've had, the topics we've covered, the way that it's grown me as a professional, I'm really grateful for the opportunity to get to 100 episodes and all of the people that helped me get there, including my team and all the wonderful guests we had. So I wanted to do a special episode today for our 100th episode. And this is going to be, one of the questions sometimes people ask me is, why don't you really do much tax stuff on your podcast? And I think for me, a big reason why I don't usually have a big emphasis on the tax side of things is because it's hard to make it evergreen content because the tax laws are always changing. And then also, for the most part, it's such idiosyncratic advice when it comes to what's actually going to work for an advisor for tax strategy that oftentimes really learning all of this stuff or me presenting in so much technical detail, it can just create a lot of overwhelm rather than bringing a lot of clarity in my experience. But on today's episode, I'm going to be focusing on a presentation that I tend to give to other groups, or I modify this for different situations. And today's episode, we're going to be doing Maximize Your Value, the Accounting and Tax Foundation of Business and Succession Planning. So I'm going to be painting a very broad brush with a lot of different topics today. And the goal is really to take you through the progressions of areas where I see pitfalls working with firms and go through different opportunities and ways to kind of look at these things. For those of you who are listening in on an audio only format, we're going to have in the show notes nearby the video version of this because it does have an accompanying slide deck that has a lot of detail on it, and that will help kind of bring cohesion to what's going on. But I'm going to try the best that I can to kind of speak generally with this stuff so that if you're on your way to the grocery store, wherever you are listening to this, at the gym or wherever it is, you'll still be able to follow along without the visual cues. So that's my goal for today. So this presentation, I'm going to be going through kind of 4 big buckets of the areas that I like to look at when I'm looking at a firm's planning. So I'm going to start off with step 1, which is essential accounting infrastructure. So I picked the sexiest thing first, right? Essential accounting infrastructure. Then we're going to go into the second step, which is once we've got that good infrastructure in place, now we can have fun doing tax planning. So we're going to talk about some common tax planning opportunities, which are things that you could be implementing today. And then we're going to move on to step 3 and step 4, which are both centered around succession planning. So we're going to start with succession planning for today. So what are the things you need to be doing right now to think about succession planning? And then step 4 is succession planning for the future. What do you need? If you're really in an active succession planning situation, what are some of the very high level things that I think you should be thinking about just based on, my experiences in casework with advisors doing this. So my goal for today is really to make this a red flags orientation. This isn't going to be me teaching you how to file an S election. This is going to be, in my experience working with advisors as their advisor, the kinds of questions that they ask, and giving you a primer on, what are the things that you should just generally be aware of, and how do these things work from, more layperson's perspective, so that you can be a good conversation partner with a tax professional when it comes to these things. And the nice thing with this is I'm orienting this towards my experiences working with firm owners directly, but all of these things for the most part are also going to apply if you work with business owner clients. It will also help you understand better kind of some of the tactical and strategic things that go on in the high level tax planning for business owners. So I'm going to try to keep everything very action level. And I invite you, if you have questions or you want to do, you have specific things that stick out, please feel welcome to send me a DM on LinkedIn, because I'm always trying to tailor this content to really drive towards what advisors in real life are asking me. So a little bit of my background, I'm just going to assume that this is not your 100th listen of the show. So my name is Catherine Tindall. I'm a CPA with Dominion Enterprise Services. We're a CPA firm that specifically niches in tax planning and income tax returns for financial advisory firms. So we work with people at broker-dealers, we work with RIAs, we work with 1099 advisors, IARs. The common niche for us is really just wealth management practices, their owners, and kind of integrating closely held planning for them. I've had over 16,000 people attend my continuing ed presentation, so I hope that means that I've gotten somewhat better at it over time. So that's my background. And then for this, because this is just a podcast, usually in these presentations, we do the, submit Q&A afterwards and I'll answer your questions. But just as a special offer as part of this podcast, if you have any questions off of this, feel welcome to reach out to me on LinkedIn, or we'll provide other contact info nearby. Feel welcome to ask questions, mention that you saw the podcast, etc. And then also for those of you who are interested in getting a copy of the slides, just contact us and I'm happy to send you over a copy of the slides related to this if you want to keep it. And that's that. So first step is essential accounting infrastructure. So what do I mean by that? Because that's a lot of jargon. Basically, when I look at firms and advisors, the first place that we need to start from an accounting perspective is having correct projected profit and loss and balance sheet financial statements. And so the first step of that is having a strong record keeping function. And I'll talk more about this. And then once you've got that record keeping function down where you know historically what's going on with you, then the next piece is you have to be looking at forecasting. So what are you expecting to happen through the rest of the year? What's your budget for, what do you think your revenue is going to be? What's your budget for expenses? How is it going to change? Those sorts of things, because that's the basis for us to actually be able to do tax planning off of. And so once you've got those correct projected P&L and balance sheet, because both of those interact with each other, and we'll talk about this more, then you're able to have you can have a tax forecast run prior to year end to see what your initial tax liability is. What's the action item there? Having a strong tax professional relationship. So if you're not utilizing Holistiplan for yourself or other tax planning things for yourself, or if you're not familiar with how to do tax planning for yourself as a business owner, because it is quite nuanced compared to just, say a W-2 solo person, it's going to be a little bit different. And so, really that essential accounting infrastructure is going to need that tax forecasting. Because when I talk about tax planning with people, there's really two big the two big top secrets. The first one is this, which is, if you want to have good tax savings and have consistent tax savings, the main thing that's going to trigger that is not like any one, technique. It's about having a systemized relationship with tax. Typically that means having an integrated relationship with a good tax professional, or having the acumen yourself to do it, and having the accountability and having the systems to actually do it timely. So that's the first tip. Like if you want to pay less in taxes, having a systemized relationship with it and a process around it is going to be the first biggest step. So what's the importance of strong record keeping? A lot of advisors will ask me about bookkeeping, and there's definite varying levels of competency and understanding with what's needed for strong record keeping and what I mean by that. And so the importance of it, before I tell you how to do it, I want to tell you why to do it, is that when you have a good record keeping function and you're getting accurate profit and loss statements and you have an accurate balance sheet, it's not just nice for the bank. When you get used to using these as tools, it allows you to know your margin and your performance in real time. So if you're only getting your books caught up once a quarter, or you get them caught up annually, you don't really know how you're doing really until you do that process of having the accurate record keeping. It also gives you the infrastructure to start to look forward. So if you know, hey, the last 6 months or the last month, I was this profitable, what can I expect for next month? What can I expect for the next 3 months? How did I change from the last 6 months to the current 6 months? It gives you that infrastructure to start to try to predict what you think is going to happen. And then also with record keeping, it helps you determine your taxable income before you start doing planning. So when you have an accurate profit and loss statement and you know what your profit is, you roughly can predict what your taxes are going to be, right? Because if it's this amount of profit, it's going to go through the tax funnel this way, and you're going to get this amount of tax on the other side of it, right? So it lets us decide if we want to make changes or if we like that, but it gives you the standpoint of knowing where you're starting to know what techniques are appropriate, and to know what's appropriate strategically in the practice. And then it also allows you to focus objectively on the performance of different areas in the business. So if you have your P&L set up correctly, depending on how you have it structured, it'll also let you start to track things like, well, how much labor, what's my revenue per labor dollar? It also gives you a way to measure lead KPIs against lag metrics, right? So how many new sales calls did we have, which is a lead KPI, versus lag measures like, well, we had this many new sales calls, but new revenue, because we track that differently, is only this much. Well, that, it shows you that you have a problem in the system, right? So my top recommendations, because I know for a lot of people, record keeping is a fairly overwhelming, bucket. The answer is also different for different people, whether you should have a fractional CFO, or whether you can do it yourself, or whether you have a bookkeeper, or whether you have, a spouse do it. My top recommendations are basically two things. First of all, that record keeping should be an automatic function in the business. This is a hygiene thing. It's just, it's important, but it's not urgent, in the Eisenhower matrix. And so it often gets procrastinated, and then it will spin other problems out because of it, specifically with the tax liability, because the profitability is driving the tax liability. And for most advisory practices, I know that the tax dollars walking out the door are very significant. After we look at labor costs, usually taxes are the next most expensive thing. And so the record keeping function should be automatic. It should be something that it doesn't need to be kept up with by you as the firm owner. Now, for those of you who do your own books and you enjoy it, if it basically feels like an automatic function to you, I have some advisors in our firm who do their own books, and they do a great job, and they're timely, and it's valuable for them because they like being in the numbers. They run a lifestyle practice, it helps them. But for some advisors where it feels like I can't get out from under this, or I'll get to it, or, oh, well, I can do it. You have to think about the brain surgeon who's doing his own, lawn mowing, right? If you're the brain surgeon and you're not getting this wonderful joy out of doing the lawn mowing of your own bookkeeping, just find somebody else to do it. The other piece that I always say is it's really different when you cook your own Thanksgiving dinner versus just sitting down to eat Thanksgiving dinner. Like if you've ever cooked a Thanksgiving dinner for yourself, like been in the QuickBooks, reconciling the transactions, you can't find this $50 or whatever it is. Then when you go to try to eat the meal, you're like, I've just been smelling this all day. Like, I don't want to look at this. Versus if you've only got like 4 hours allocated to your record keeping each month, use that as the eating the Thanksgiving dinner. Use it as I'm going to look at these financials. I want to be strategic. I want to be seeing what's in here. What do I need to change? What am I tracking? What am I doing with this? Instead of like, I'm trying to chase down the $50 or this bank feed's not working, right? Like that's you're just not going to get the value out of it. The second piece of advice is using a formal accounting system. So this is going to be using like QuickBooks Online, all the different softwares that do accounting. Accounting it's a system from the Renaissance. Like it's, some of the oldest records that we have in human history are actually accounting records, believe it or not. The system itself, it's a pretty integrated logical system. So as long as you're using something that has been built to be used for accounting, usually it's going to be following the same of the ancient formulas and all that stuff. So I wouldn't hang up too much about the software itself. It's more that whoever is using it needs to be aware of, accounting basic standards and following those standards. So big ones that I see get goofed is having non-commingled funds. So business funds are for business, personal funds are for personal, that you use business bank accounts and business credit cards exclusively for business stuff. Second one, which surprisingly this will get missed nowadays because of bank feeds, but doing statement reconciliations. So actually downloading your bank statements, doing the reconciliation function inside of QuickBooks and making sure that those are reconciling. And then when you have entries that don't reconcile, so say, activities that don't clear, looking into that and making sure that that's actually right. I've had some people where they've been reconciling their bank statements, but have like 100,000 of uncleared activity that's showing up on that reconciliation each month. You got to make sure that you actually know what you're doing with this. And then the last piece, which, when you're vetting bookkeepers or you're vetting accountants, a great question to ask is, so what do you do with the balance sheet? Because to have a P&L correct means that you also need to have a balance sheet that is correct. And for the most part, as accountants, it's much easier for us to start with verification of the balance sheet because it's usually referencing external things like bank accounts, credit card statements, asset purchases, credit card, amounts, loan amounts, things like that, that we can reconcile that fairly easily. And because it's the mirror, it's the mirror of your profit and loss statement, that those are actually intimately connected with each other from an accounting perspective, that if the person who's doing your work doesn't have a strong foundation in balance sheet review, likely you're going to have more issues on the P&L side of things, which is going to impact, how if your profit isn't right, then your taxes are either overpaid or underpaid, and you don't want either of those things. So once you've got that kind of basic infrastructure with the record keeping, the next piece that we look at is the tax forecasting. It's important to have a forecast done during the year because you want to know what your liability is before you make changes, because you might find that it's more strategic for you to pay more taxes depending on where you are, right? And then it also allows the ability for us to run scenarios for planning ideas. We want to see how the game is going while we're playing it so that we can make changes. The lovely thing with the tax code is up until December 31st at midnight, your tax year is open. You can make changes. You can control that tax liability. And then once the year ends, once that once that carriage turns into the pumpkin at midnight, then we're stuck and there's not a lot that we can do. There's some maneuvers like with retirement planning that we can do after the fact, but for the most part, the game is played, while it's open. And so we look at things like, do we want to change AGI? What are we expecting this year versus next year? Are you in a high rate this year and a lower rate will be happening next year, or vice versa? Are there techniques that are going to make more sense this year because it's a high income year? Or sometimes just paying taxes is the most strategic move in the business. So if you're building up your balance sheet, if you're building up cash in the business, if you're paying down debt, if you're doing an acquisition, those are all things that build up your balance sheet that are going to get funded, unless you're getting external financing, are going to get funded from taxable profits. So they're going to have to go through the tax funnel before they come out to your balance sheet, right? And sometimes that's the most strategic move. A lot of times when I see advisors growing their practices, building up their balance sheet, especially for the first couple of years, is actually an important safety metric for them. And then especially for RIAs, you do have those regulatory requirements about basically having a certain amount of capitalization in the business. So you also need to watch out for that. So tax strategy needs to be strategic. And so when we think about tax strategy, we have to think about it in the context of the business itself. So there's a couple of different, kind of components that I think of with this. So I have some practices where they're a high inorganic growth practice, which means that they are, they're basically reinvesting aggressively back into the business from taxable profits in every year. I'm going to talk about this more because, I already said there's two big secrets to saving taxes as an advisor. This is the second one. And it's not really that much of a secret. It's kind of in plain sight, but I'll give you an example of this. And then other ones, you've got your stable organic growth practices. So these are the practices that maybe are growing 10, 15% a year. They go up with the market. Their number of households doesn't shift around a lot. So for them, it's definitely a different set of techniques that we look at from a tax planning perspective. And just in general, when you're in a stable organic growth practice, you're just going to pay a lot of tax. Like there's not really a good way around it. Just because you're triggering a lot of taxable profit, there's really only so much that you can put into retirement vehicles. And so unless you start moving into other ways to try to reduce your taxable income, like real estate or something like that, you're just going to be stuck paying a lot of tax. Like that's just the way the code's written. For people in service businesses, if you don't have assets to depreciate and you're not having deductions, you're just going to have taxes. Two other things to be thinking about as well when it comes to the tax strategy is if you're going to have a sale of your practice, you also want to be cognizant of what you're doing with your profits and your planning, because you're trying to coordinate hopefully with a good valuation. Or if you're doing acquisitions or succession is starting. So if if you're an advisor and you've got a junior advisor who's going to be purchasing tranches of your business, like 20% every year, we need to be thinking about also what we're doing with the tax strategy, because the business might have additional cash needs. If the business is having to basically having to self-finance that purchase because the advisor who's getting that 20% is then using that 20% to buy out shares from the other, from the first generation advisor, that's going to have to be paid. Taxes are going to have to be really strongly considered with that. So things like financing needs, operational drag, stuff like that, you got to think about it, and that the tax strategy really needs to dovetail back to the operations. So in terms of like the infrastructure, right, to put a bow on this, so we start off with the good record keeping so that we can get a projection, so that we can say, okay, what's the current actual tax liability? If this projection was 100% right, the crystal ball is perfect, and this is how much taxable income we're going to have this year, what's the current tax liability? And then from there, you make the decision of, okay, in light of everything else that's going on in the business, what do we want to implement this year? What are the tax planning technique scenarios that we're going to try to implement that are actually strategic for the business, that are aligned with our other goals, that aren't too clunky, etc. And then once you have that, then you end up with your new tax liability, right? Say it was 100, we wipe out 50 through doing techniques. We've got 50 left. Great. We're happy with the 50. We're going to pay the 50. So then mechanically, what do we need to look at next? And that is, how do we need to deal with the actual mechanical estimated payments? And this is also another area I see a lot of advisors kind of struggle with. So what we recommend is, using quarterly estimated payments. It's less fussy than doing it through your W-2s, though if you're really behind, doing some large payments through your W-2 withholding, if you're a S-Corp owner, at the end of the year can help you avoid interest and penalties, but that's a much more technical, nuanced conversation. But for the most part, most advisors are paying most through their quarterly estimated payments. And then usually what we recommend is focusing on your safe harbor requirements with the IRS in your state. So what do I mean by that? The safe harbor for federal is usually 110% of last year's tax liability or 90% of current year's tax liability is the minimum that you need to pay in overall withholding and estimated payments in a year. And then you basically need to catch up by April 15th. We recommend focusing on when you're actually making the payments during the year, targeting those safe harbors, because if your practice is growing year over year, you don't want to prepay your taxes because you get no benefit out of it from the IRS. The only benefit that you potentially get is if you're afraid that you're going to spend the money that you owe to the IRS because you can't keep it in a separate savings account, then yes, there's a benefit there, but there's really no other benefit to prepaying. And so what we usually recommend doing is, once you know what your actual tax liability is, say it's 50,000, I'm just going to use random numbers. Say it's 50,000 for the year that you need to pay in through estimates, but your safe harbor is only 10,000 because you had a big transition year this year. Well, you don't get a benefit from prepaying that 40. You're better off waiting until April 15th to pay the 40 and just pay the 10 in now. That way, that 30, you can put it in a high yield savings. You're getting some money off of it. Also, if you get towards the end of the year and you realize, actually, I want to make some some write-offable deduction investments back into my practice, I haven't prepaid all of those taxes and now we'll need to file a return in order to get them back. So that's why we recommend earmarking it to a tax savings account. And then really the mechanism, the way you should be calculating this is, okay, if I'm making so for a lot of advisors, they earn a lot of their income quarterly, right? And so what we end up recommending when we're working with people directly is that if you make a lot, if you've got a big quarterly payment coming in on the 15th, great. Have a forecast done before that so you know roughly how much of that should be going to this tax savings account, how much is actually going to go right out the door to a quarterly safe harbor payment. And then when you're looking at your cash accounts, you're not wondering how much is the additional tax is going to be, because you've already, from the revenues, I'm recording this in April. So say, the revenues that are going to hit me April 15th, I'm already kind of paying the taxes, so to speak, because I'm depositing that money in a tax savings account when the revenue hits me, based on a forecast that's formally done. I've had some people too, where they didn't do the forecast and they oversave on taxes. And so what ends up happening is now that cash is being, that cash just represents profits that are being taxed, where it's kind of choking the business, that it could have been used for doing things to improve the firm, but the owner was, didn't want to fall behind on the taxes, and so actually oversaved on taxes. So it can be negative if you oversave. Definitely, most advisors the first year you're self-employed, what it's like that first year of, oh wow, like that's a big check I've got to write all of a sudden. So just having a relationship with it, because it only gets trued up at the end of the year for your actual tax return. So that's why really it makes more sense for you to try to, quote unquote, true it up earlier so that you're not getting surprises and that you're not falling behind. So that's the essential accounting infrastructure. Very, very fun first topic. I'm going to go into next common tax planning opportunities because this is where the fun is. And then we'll move on to the succession topics. Catherine here. Just wanted to say thanks for tuning into the show and hope you've been enjoying it. Since we're all at the mercy of social media algorithms, if you wouldn't mind rating the podcast on whatever platform that you listen to, I'd really appreciate it. And also, if you're looking to stay in the loop on current tax updates, what the firm is working on, and just the things that I think you as a firm owner need to be aware of when it comes to the world of tax, you can sign up for our newsletter using the link below. I only send out editions when we have really useful things to share or things that I think are important to have your attention and energy on. So let's get back to the show, and thanks again for being a listener. So at the end of the day, when I'm looking at tax planning, I'm optimizing for three things. The first is, you as a firm owner, the value of your time is extremely high. If I'm going to tell you to do a tax savings technique, but it's going to distract you from something that's much more valuable for your business, such as prospecting for new clients or training a junior or whatever it is, it really has to be worth it. So we always want to optimize for your mental sanity and your time, because those are really the limited resource. Whenever we're working on things, time is always the limited resource. Like money is a renewable resource. You can always get more of it. Your time as the firm owner, once it's out the door, it's out the door. The second piece that we focus on is value generation in the growth of the asset that is your practice. So your business, if you're an advisor and your client, your client sitting across the table from you had an advisory practice like yours, how would you be advising them? It's going to be a huge part of your portfolio. For most of the advisors we work with, it's a huge part of their wealth portfolio is their firm. And so we really want to make sure we're being intentional about building that asset up correctly and doing things that are going to help grow that asset and optimize it, because at the end of the day, we could nickel and dime try to save taxes, but really we're wasting time from the real thing, which is growing the asset. And then the last piece is that we don't want to run out of cash. Cash is the oxygen of the business. And when you're doing tax planning, you have there's a number of techniques that are available to you that do not use cash. So they're techniques like entity, we'll talk about this. The vast majority of techniques do use cash. So it's like I'm going to spend $1 to save my marginal rate techniques. And so we just have to be really careful with them. And I'll talk about that. So I emphasize cash because my priority in planning is I always start with the cashless techniques first, right? These are, one pocket to another kind of deductions where you're spending the money either way. Let's just make it more efficient. It doesn't, quote unquote, cost us anything to save these. Then I start focusing on tax planning that uses cash, because if we're going to use cash, we really have to consider the opportunity cost of that cash. Are we going to burn cash and we're going to get a planning outcome that ultimately is going to increase the value in the business? And if we're not, then I would rather just pay the taxes. So instead of setting that dollar on fire and saying, hey, I just saved 35 cents by setting this dollar on fire, I'd rather just see you pay the 35 cents and keep the difference. So always keeping in mind true opportunity costs of when you're doing techniques, which includes your time, and it also includes what that cash could be doing elsewhere. So just as a side note, something that I recommend in general is if you haven't done one of these, it's a wonderful technique, is to do an annual time study to know the value of your time. So if you take how many hours you spend per year in your practice and how much compensation plus profit you're generating in the business, that gives you roughly what your hourly rate is. And if that number's lower than what you want it to be, really trying to focus on going for higher leverage activities that are going to help you increase that number. So a couple of other areas kind of in the conversation of opportunity cost is, so I see a lot of advisors, they'll ask me questions about tax planning techniques, and I can see in the background what's going on is they like to chase after reducing tax waste, which is a good thing. We don't want to be paying additional taxes, but I would be suspicious of activities that are pursued purely because of tax savings and not because of, oh, well, we're going to do this anyway, and it would be nice to make this more efficient, right? So often I will see this with real estate or with hobby ventures, and it's just a general warning of, something I've seen over my career is, if you're going to pursue things because of tax savings, it's because you don't have something stronger on the table for you. One of the pieces, though, I do want to, recommend is that real estate, for the most part, besides having the structured relationship with tax planning and those, deductible annual expenses that you can be doing, which I'm going to talk about that in a lot more detail in a minute. Granted, real estate depreciation gaming is one of the best tax strategies in the code. And part of what makes that work is the fact that you're getting to write off an asset, you're getting these deductions every year, but the value of that asset should be basically staying the same or like going up. That's the hope. And so you get this nice arbitrage that happens. But for you as an advisor, if that's not like the main activities that you're doing, if you're not getting joy out of this and it creates a lot of noise in your life, then it might not be strategic. And so, usually for advisors, if it's like, well, we're going to buy our own building that we operate out of, and it's just going to be more efficient, and we're already having to deal with a bunch of stuff because we're in a triple net lease anyway, then great. Like that can be a convenient, good technique. If it's, I'm going to pick up a couple of properties and dabble in this, I've seen that not go so well for a lot of people. So I'm going to talk about some cashless tax planning techniques. First is going to be entity choice, which is going to be, behind the curtain of the magic S corporation. I think probably 80% of my questions from advisors, that's not true. I would say 60% are S corps, 40% are succession planning. We're going to talk about some of the components there. And then I'm going to talk about one pocket to another style deductions. So these are things like pass-through entity tax, which is paying your state taxes through your entity, QBI optimization, so qualified business income deduction optimization, especially for people with statutory W-2 income. You know who you are. If you don't know what I'm talking about, then don't worry about it. Hiring kids and spouses, health accounts, so like HSAs and reimbursements. Loss and gain harvesting, in my mind, go in this category. But as an advisor, you guys know these, so I'm going to skip them. And then the last one that's like a big one pocket to the other deduction is cost segregation studies, which I'm also going to skip because that's primarily targeted to real estate. If you own real estate property and you don't know what the term cost segregation is, check it out or send me a DM because it could be a very valuable thing for you. So S corporations, the mechanism of the S corporation that saves you tax is that it limits self-employment tax to the reasonable, and that's the technical term, reasonable compensation of the owners via a W-2 that they issue to themselves. It's a long conversation on how this is calculated. I'm just going to give you the short story that you need to know, which is that reasonable compensation is a number that there's specific IRS testing for how you come up with what an appropriate number is. It needs to be market-based. We use a tool that is designed to do this. It is in the show notes, in the slides that you can get. And I would recommend, if you work with a CPA or, you're concerned about reasonable compensation, go through the process of doing a formal survey, instead of picking a number out of a hat. I would say probably 80% of the time I look at firms, the W-2 number that's selected is actually suboptimal, and it's usually quite expensive. In one way or another, that they're either underpaying themselves or overpaying themselves, and it just triggers unnecessary tax. So I would definitely look at that. And then the second piece that the S corporation allows you to really save tax on is allowing for you to pay some of your, in most states, pay some of your state taxes for you as an individual at the entity level. So it gets around the state and local tax deduction limitation if you're, subject to that. But we'll talk more about that in detail. And so just as an example, if you've got an S corporation that's making those state tax payments, and we assume like a 6% rate, married filing joint, say you've got a firm that produces $500,000 of profit and then $120,000 of owner's compensation. So that would be above the line. That's, it would be, revenue less expenses less owner's compensation equals $500,000. So $120,000 of owner's compensation. So you're getting hit with $620,000 of taxable income. Roughly, and a PTE, so the pass-through entity tax payment of $30,000 at that rate would roughly save you about $35,000 annually between around 10,000 saved through the pass-through entity tax, and then 15,000 saved from the self-employment taxes. This is just a really rough example to show you kind of mechanically how it works. And so for S corporations, some complications here of why you wouldn't want to do this. First is, fringe benefits typically just get added back to you as an owner. So if you do your own health insurance, it's going to have to route through your W-2. You don't really get any additional deductions that you wouldn't normally have just as a Schedule C filer, which is, if you have an LLC and you don't elect into being an entity, you're going to be a Schedule C on your normal individual income tax return. You are required to pay yourself a reasonable compensation before you take out distributions. So if you, for instance, I have a case of an owner who's not planning to take out any distributions in the first year because he's building up his balance sheet. In that case, he doesn't have to pay himself a W-2. But for most people, they're going to be taking money out of the business, so you need to do that W-2. And then there are limitations when you're dealing with multiple owners. So just as a warning, if you've got multiple owners in an S corporation, it is a very rigid structure. Maybe I'll do another episode on ensembles if enough people tell me they want to hear about it. But just know that it's really difficult to run an S corporation successfully, I think, with multiple owners, unless you really do have, a really integrated book and, very, very aligned, like I've seen this work with like spouses and stuff, but for the most part, it ends up kind of creating a lot of friction unless it's a kind of short-term arrangement. And then you have assignment of income issues. So I don't know, speaking to this audience, people are kind of all across the board regulatory wise. You just have to take care for how your revenue gets reported. There's a tax court case called the Fleischer case. I post a couple links in this that's got a really good tax advisor article. And then I did a special podcast on this with another CPA. In general, income that gets 1099'd to your social security number gets stuck on your personal return. And then just a lot of care is needed to get that back up into an entity structure correctly. So just a word of warning there. So next one pocket to another. For the pass-through entity tax, the pass-through entity tax credit, it takes advantage of the loophole for the state and local tax cap on federal returns. Now, the nice thing is that this was raised in 2025, so this current tax filing year, through 2029, up to 40,000, but it starts to phase out around 500,000 of modified adjusted gross income for married filing joint. It's one of those things where you want to have a forecast done and kind of see where you are with this. But for the most part, the PTE, the pass-through entity tax, even if you've got that full 40,000 and you're itemizing, a lot of times it actually still ends up being quite beneficial. And it can be particularly helpful on non-itemized returns as well. So I've seen this where I have, a married filing joint couple where, they're not itemizing because the advisor is older in the practice. He doesn't have mortgage interest anymore. His house is all paid off. He's not doing a lot of charitable. He doesn't have a lot of medical expenses. He's not itemizing. And, so we're able to get that nice standard deduction, and we're able to kind of double dip on the state tax component through the pass-through entity tax program. So definitely something to look at because you're just paying that money either way. You might as well make it efficient. It's a state-by-state program, so each state is different. Their due dates are different. If you're in New York, be extra careful with these because the due date is ridiculously early. And it just usually needs to be done before the end of the year for the benefit. Some states you have to elect into it earlier, so definitely just check it out. And typically the benefit is your top bracket rate. So if you're in the 35% bracket, each dollar that you pay via PTE, so if you pay 20,000, you'll save 7,000 at that bracket. So it's nice. It's money you'd pay either way. Might as well make it more efficient. The next one is the QBI deduction. This is one of those areas where, I could do a whole presentation on QBI. It's a very an annoying and lengthy tax topic, right? The QBI deduction, the qualified business income deduction, it's a 20% deduction on business income. It's got a lot of rules around it about what qualifies and what doesn't. There are phase out thresholds. I've got a detailed slide here for you. And for those listening, I'm not going to drag you through the mud of reading all of the numbers, but basically what I want you to know around the QBI deduction is that if you've got insurance income, so if you're a statutory W-2, and you get a lot of insurance income or you get a lot of 1099 insurance income, it can be subject to different rules than your normal brokerage and advisory income, depending on how you earn it and those kinds of things. I had one client last year where they didn't separate out the insurance income, and it actually triggered an additional $70,000 in taxes for them because of the missed QBI. So definitely something that if you have a lot of insurance, you definitely need to proactively look at this. But if you don't, it's a relatively manual calculation. If you're having a tax forecast done before the end of the year, this is just a question to the CPA of what's going on with our QBI. Are we totally phased out of it? Are we close to phasing into it? Do we need to do things like increase the amount of wages that are going through the business to optimize it? Are there ways that we can artificially control our profit in order to get back into it? Like I had one advisor where he was basically in a 50% marginal rate because he was phasing out of QBI. And so we were able to have him do additional retirement contributions and different planning things to get his profit number in the business down so that he would phase back into QBI. So those kinds of things, if you're getting close, if you're around the 400,000 to 550 for married filing joint, or, single, 200 to 276, if you're anywhere near those ballparks, QBI planning is going to be something that you want to be paying attention to. So one pocket to another deductions. Let's talk about some family things. Need someone to lick stamps for a direct marketing campaign? Consider hiring your kids. Now, everybody asks me about hiring the kids. Basically you can end up with, a free 15 grand if you can pay your kids because, if you're doing it through an entity, it's going to be subject to self-employment taxes. If you do it as a Schedule C, there's actually some rules where you maybe can get out of it depending on the age of the kids. But it's just one of those things where it's kind of a have. So if you have kids where you want to get them involved in the business because you're kind of trying to suss them out to see if they might potentially be interested in going into the business, because a lot of the firms we work for, it's, multi-generational. This is a great starter way. Also just depending on your family culture, right? Like if you want the kids to be earning some of their own money, whatever it is, but I wouldn't do it purely from a tax planning perspective. It is nice once they've got that earned income, so you can start doing Roths and things like that for them. But it is a bit of a needle to thread. The bigger one that's a nice is if you have adult children in a business. So very often when we see these multi-generational firms, you'll have first generation who started the firm, adult children who are working in the firm, and then those adult children start to have their own children. Those grandbabies come on the scene. There's some really nice family leave credits for parental leave, and they can be pretty significant. So we had a client this year where son went on leave, and they ended up saving around $15,000 in a tax credit, for the birth of the grandbaby. So that's, a win-win, and it's really actually quite easy to get from a tax perspective. So great one to think about. When you do have the kids on the books, like the younger kids, just make sure you're paying a market wage for bona fide services. So, if they're really not actually working, you can't just stuff $15,000 on a W-2 to them. You really they really do need to be working. And like I mentioned, it can be a better benefit under a sole proprietorship because of the self-employment taxes. So if you've got some Schedule C income kind of running alongside your S corporation, it might be better to hire them through that side of things. You do need to put them on W-2, so you need a formal payroll filing. Other things too, like hiring spouses. If you've got spouses kind of working in the business, having them be able to participate in retirement plans if they, aren't employed elsewhere. You have other things too, where if you have a lot of medical expenses, there's other techniques that you can get kind of around with those family activities to make it work. Another common miss, and I don't see this as much with advisors, but I've seen this over the course of my career, and maybe for you as an advisor looking at your clients, would be married filing joint versus married filing separate. If you're ever looking at a client's return and they have married filing separate, and it's not like a legal requirement for us, like a tuition repayment program or something strange that's forcing it, definitely make sure that that's actually an efficient status for them. I've had this happen so many times over my career where people did married filing separate because it was, quote, easier for each of them to do their own tax returns, but then it was costing them like 15, a crazy amount of taxes for easy when it's just, so definitely check that out if you see that on a return, if you review returns. And then just a couple of other things like consider 529s, HSAs, spousal IRAs, those are bread and butter for you guys, but worth mentioning. Retirement contributions. I always say save your tomatoes. My general philosophy on this is, this is where our worlds collide. I've got my 2 cents, and at the end of the day with retirement contributions, it's whatever the advisor's intent is with it, right? But the one piece that I like to bring to the table is just consider the opportunity cost of the capital. So if we're going to be putting away, we've got a solo 401k, and we're going to be putting away 70 grand that you're now not going to be able to touch, and that will be subject to taxes in the future. Is that a good opportunity cost? Are you getting a good return on that compared to what it could be doing in the business deployed as an investment into the business? And if the answer is yes, because, maybe deploying it into the business is more risk than you want to take, or you don't actually have a lot of things that you want to do in the business, then great. But I always just recommend consider the opportunity cost first, because I find for a lot of advisors, they just kind of automatically start doing these plans and don't really consider the full cost of it. For Roths, same thing, save the tomatoes. I always think of it, I leave it up to the advisors what they want to do with it, because this is really your world too. But for me, I always just consider, like, when do you want to get out of future taxation? Like, do you think that rates are really going to go up in the future? If so, then getting out is more attractive. My crystal ball is no better than yours, with the current political environment and the way, right now, as of recording, we don't have an IRS commissioner. I don't know what's going to happen with the tax code. So it really comes down to your own judgment. I don't have formal, strategic advice on those, other than I deprioritize them compared to other tax planning techniques, because you can kind of always go after these ones last after you've done everything else. Other ones is if you have employees, don't forget that there's tax credits for these kinds of plans. And then if you're an advisor that's kind of getting close to retirement or an exit, you might want to consider doing a defined benefit plan or a cash balance plan, because those can really dovetail nicely with the succession planning. Because if you're getting close to the end, close to retirement or partial retirement, you don't have to be fully retired. You might just be, selling off the practice and maybe working 10 hours a week or whatever it is that makes you happy. Cash balance plans can be great because you can sock a lot of money away in a very short time window where you generally know how the business is performing. And then also you're not that far from the other side of being able to actually take those payments out. So those can be wonderful to look at. One thing you just have to consider is that with any of the retirement plans if you've got a firm set up, is that discrimination testing requirements with employees, just something you want to watch out for before you jump into one of these, is have some good due diligence done, because depending on what stage the business is at, sometimes it can be really helpful for attracting talent. Sometimes it doesn't make much of a difference. So the next, big cash, because the retirement contributions, I just want to get that elephant out of the way, because they use cash. So I just kind of deprioritize them. The biggest cash one that you can do for tax planning, and this is the best tax savings, is investing in your own growth. I'm going to talk about this more specifically because, basically what this means is that you're accelerating strategic deductions and deferring income tax by having an artificially low profit margin. And I'm going to give you an example of what this looks like. And for those of you who don't have the slides, I'm sorry in advance. But some examples of strategic deductions are professionalizing the business. So this would be things like, do you need a CRM cleanup? Do you need software? Do you need administrative infrastructure? Do you need a VA? Coaching programs? Are you stuck? You're not getting good, like your referral program stinks or whatever it is, right? Talent acquisition, like you don't have the people you need on the team, outside consulting or marketing. What are the things that are strategically, you get a write-off today for hopefully an improvement tomorrow, and reinvesting profits back in. So just to give an example, so with no tax planning, say you've got a firm that makes $1 million of revenue, overheads around $300,000, and then the owner's salary is $150,000. So this is like a S Corp example. So your operational profit is around $550,000. So that's just keeping the lights on, running the business, paying the employees, paying the rent, keeping the clients happy. And then after that $550,000, you consider doing, let's say half of that into increasing the size of the practice, because you're at $1 million now, but say you want to get to 5. And so to get to 5, you need to make some investments back into the business, is what you've determined. So we make those $250,000 of strategic investments back into the business, but those are all things that are going to get deducted in the current year. And so without any planning, like I said, you're at that $550,000 profit. With the planning, where you've taken out these strategic deductions, you're now at $300,000 of profit. Now, I'm not going to inundate you with all the reading of the different tax lines here, But roughly the owner take home in that situation goes from, 550 to 386. So your take home is going down, but your taxes are also going down by around 85,000 by deploying that 250. Okay, like that's pretty good, right? Like I'm getting, that 250 hopefully will grow for me, and I'm getting 85 off for it. Okay, like what else was I going to use the money for? And that's always the way I phrase this, is just, what else were you going to use the money for? Because if you weren't really going to use, I'm going to build up some non-qualified accounts a little bit, but I don't even really know how maybe those will perform. Well, maybe consider putting, how much do you want to allocate to this, right? Because it's riskier, right? And how much do you want to allocate to it? And what are you okay with? And what are you comfortable with? And how certain do you feel, right? But the real kicker that I like with this is, so say you take that 250 and you deploy it really well, and you get an additional 50% on return investment in annual recurring revenue. So that 250, say you're able to produce an additional 125,000 of recurring revenue. You hire a VA where you can instruct them to do a couple things for you so that you're able to maybe collect some more assets from existing clients. Maybe, you use some of that money and professionalize some components of your funnel. So you're having more, people show up to first meetings or whatever it is, right? Like you find ways to make things more efficient in the business. You get more revenue out of it. 125,000 in recurring revenue, like nice, that's nice. But what I really like as a tax planner, and this kind of goes back to that depreciation example, is if we look at a practice where it's a 2.5 multiple exit value. So I just picked that number from some casework. Don't weigh anything on that. This is an example. So 2.5 exit value, that's going to be about 312,000 of exit value. Well, I like that. I spent 250 to get 312. That's a pretty good arbitrage. And I saved 85 that I was going to pay. I like that. And with the 312, when I go to exit, I'm paying capital gains rates instead of my ordinary income tax rates. Wow, I really like that. And the nice thing is with that 125, well, now that, if your operating overhead isn't shifting around too much, well, now we've just got an additional 125,000 of profit next year. That's nice. You are going to pay more taxes on it, but it's like you've made the pie bigger, right? It makes those taxes less painful because you've made the pie bigger. So it's a great move. Now, like I said, though, it all comes down to how confident are you that 250 is actually going to produce a return. And that comes down to, your acumen as a business owner, right? And hiring the right people and doing the right things. I've seen people waste 6 figures on marketing programs that did not produce a single client conversion, so you just got to be careful. And part of this is, figure out what are the things that you're going to allocate to higher risk categories versus lower risk categories? How are you going to test your assumptions? Are you going to sign up for that 6-figure contract? Or are you going to say, hey, we'll give you 10 grand and see what you guys can do. And then we'll give you more if you come through, right? So start, just put parameters on it, right? Like it's not gambling, it's investing, but put parameters on it and measure it so that, you can have a good sense of, because, worst case scenario, I'd hate to see you burn the 250 and it's like, great, I saved 85, but it's like, oh, we burnt 250. You got to see a return on it. So just being careful. But, if you want to save taxes as a service professional, and this will apply to your clients that are in the same line of business, if you don't have assets, this is the technique. This is the way you do it. If you want to really drop the tax liability, it comes down to strategic reinvestment. Carefully done so that you're deferring the tax liability into the future from the growth that these things are generating. So some smaller deductions, this always feels like kind of, we get the big idea and now it's all the little ideas. So a couple of smaller deductions to check out. If you have a beautiful property that you want to self-rent, like say you do some team retreats there or take clients there infrequently, consider doing the Augusta rule. You can just Google that. There's tons of literature on it. And I'm sure there's tons of hacks on YouTube. People you probably shouldn't listen to, but if you have a property like that, definitely worth asking about. It can be cumbersome. Auto mileage, you can use a tool like MileIQ if you have a lot. Long story short with the business vehicles is the deductibility of the vehicles is just subject to the actual business use. So if you're using it less than 50%, you're not going to get a really favorable deduction. If you're using it more than 50%, then we start to look at, okay, are there other ways to optimize this? I never really like auto deductions very much because I don't, it's a depreciating asset where each year you're getting the write-off, but the actual value isn't maintaining as well. So, and it's, that car's not getting you new clients unless, something I don't. So I tend to deprioritize those. And then with home office, a lot of people ask about home office. You really can only deduct the exclusive business use section of the home. So I had somebody in the Bay Area where they were using half of their house for their home office because that's the Bay Area for you. And so it was a really meaningful deduction for them. For most other people, it tends to not be that meaningful of a deduction. So just, go there if you can, but sometimes it's not worth it. One note I would make, though, is if you are making significant improvements to your primary residence or secondary residence, just keep track of all of that, because when you go to sell it 10 years from now, you just want to recapture all of it as basis. So you want to get credit for that $150,000 you put into the kitchen when you go to sell it, just because the gain exclusion doesn't track with inflation. So just long story short, any improvements, just put it in a folder and remember, hey, I want to write off for this in the future. Not that it's a write-off, but it reduces your gain. Also a good piece of advice for you to give any clients that you have, if they're doing significant home improvements, tell them to hang on to those receipts, even if they don't plan on selling the property anytime soon. Let's see what else in here I wanted to talk about. Significant charity, for many people, this is already a thing, but the new tax law changed some of the deductibility of charity, which I found to be unfortunate and weird that they went for that. But if you have significant appreciated funds and you do want to do significant charity, I always recommend considering a donor advised fund, because it allows you to have the tax planning component of it just be for purely tax planning reasons, but then how you actually deploy it down to the charities or churches or ministries that you're donating to, you can then just deploy it based on the cadence that's reasonable to you. So we had an advisor this year where he had a lot of appreciated positions, wanted to put an extra $100,000 in his DAF, and then next year he's not going to be doing any charitable because he's, he basically loaded his DAF up, and then he's going to be distributing it over the course of the year. So you can do techniques like that, but definitely consider it. And then under, I just recommend, if you do significant amount of charitable, just making sure you're having forecasting done just because of the law changes. Thanks for listening to the Financial Advisors Want to Know podcast, again, sponsored by Dominion Enterprise Services. If you found this episode valuable, I would love to personally hear from you. Connect with me on LinkedIn and send me a message. I'm always interested in your feedback, future episode ideas, or questions you'd like to see covered in a future episode of the show. And be sure to subscribe to our monthly tax update newsletter, where we share timely tax insights and planning considerations specifically crafted for advisory firm owners and what we share to our own clients. We'll see you next time.